There are new reporting rules around bare trusts here in Canada that will likely affect many of you watching this video. Now, if you don't know what a bare trust is, I don't blame you. It's not in the Income Tax Act. But I have my friend Shane here from Clearline CPA to explain a bit more what a bare trust is, some common scenarios that many of you fall into, and the reporting rules as we head into tax season. So Shane, thank you for joining us today. And first off, let's start with what is a bare trust?
Yeah, for sure. Well, a bare trust is something that's been talked about a lot recently. A bare trust is usually where you have a relationship, where you have someone that controls an asset. Typically, they're called a trustee on behalf of somebody else, a beneficiary. And so it's that an agency type of arrangement where you have someone with controls for legal purposes, but really someone else actually owns that asset.
Okay.
And so they're the ones who take the benefits of it. Are able to use it or whatever the asset actually is.
And that could be in a personal or a business use scenario, which we'll jump into here in a second.
That's correct. And there's lots of common examples that we have out there where you have bare trusts, and most people don't realize it. Sometimes you have formal bare trusts where there's actually an agreement in place for the trust.
Okay.
And sometimes it's just a lot of informal arrangements where people don't realize that you actually have a bare trust situation.
Which is why we're doing this video today, because probably 80-90% of people watching our videos fall within this.
That's
or
correct.
It's very likely you might make a decision that makes you fall within this. So let's jump through some examples where bare trust may apply or may not apply both in personal and business.
For sure. So usually when it comes personally, the most common bare trust you'll end up seeing is in a situation where you have an elderly parent and they're doing some estate probate type of planning. And so what they do is they go and stick their adult children on title. And that way when they pass away, the goal is that the asset will just transfer to the children without some of the same estate issues and probate issues on that. Mm-hmm. Well, now you have that adult child that's actually the legal title, part of the legal title holder, but they're not beneficially interested in that property. It's more the parent's property still. Well, that creates a bare trust. Flip it around, and it could be where you have someone who needs assistance with their mortgage and requires a parent to go and co-sign a mortgage. And sometimes the banks require the parent to be put on legal title for that. Well, it's not the parent's house, it's their child's house. But now they have this bare trust relationship, and therefore it has concern now under some new rules that have come out. Yeah. And then there's bank accounts too, and it's the same thing with elderly parents, is where you have people will go on bank accounts to help facilitate that probate and estate planning when their parent passes away. Yeah. Well, again, now you have that signatory on the account, where it's not actually their account, it's their parent's account. And again, same thing with minor children, where like I could set up a bank account for my child, where I'm the trustee of that bank account effectively, but it's my child's money. Yeah. And so this creates this trust relationship, a bare trust.
So all four of those examples, you would be qualified or have to file a bare trust filing.
Yes, under these new rules that come out for the 2023 year, you're going to have to actually file what's called a trust return to report to the Government of Canada that you actually have a trust arrangement on it.
So a lot of you watching this will be, you're joint on, maybe your kid, maybe you helped co-sign and you're part of the mortgage or ownership there. A lot of you I know reach out and you say, you know what, I'm on, my parents added me onto their bank account to help pay bills and just when they pass away. This all qualified, and that's why we want to do this video, because there's a lot more situations that apply than people may realize, and you may have to do this bare trust filing. And again, we'll get into the deadline and how to file here in a second, but maybe run through some business case scenarios.
Yeah, so the common business situations that we'll see is usually in the real estate realm. And so usually it's real estate developers when they're dealing with partnerships or joint ventures, and so you have a different legal title holder on a property than who is beneficially interested in that. And as I said, it's used quite frequently in real estate developers. Mm-hmm. The other context we see a lot in real estate is where you have corporate reorganizations, where we're moving assets around a corporate group, typically done on a tax-deferred basis, but you might end up with a different legal title holder than who actually is beneficially interested in that property. Okay. And so it's very common in business situations too, and so you could end up with some of these traps that you fall into. And then professions also have some of the issues. Like you think about lawyers. Well, they have trust accounts all the time. Now, there's some exclusions what they might hit, but different professions, real estate agents, property managers, and things like that might have some of these trust accounts would now qualify for these reporting rules.
So we had a client not long ago that had many rental properties, and they were all kind of held separately and different partners on each one. Would there be a separate filing then for each property potentially?
Potentially, yes.
Yeah, okay.
So you'd have to look is, do you have a trustee and a different beneficiary for every single one of those relationships? And where there is, then you're probably going to end up with a separate filing for every one of those relationships.
Okay.
And this is part of the problem with these new rules that have come out is there's still a lot of uncertainty on what the rules are. The government still has not provided a lot of clarity what's needed for some of these rules, and just the amount of filings or potential filings what can result because of this.
Yeah. Well, how many times have they pushed off the filing? 3 or 4 times?
They've pushed off 2 times. They're supposed to come in 2021, these returns. It got pushed off 2021, 2022, but now for 2023 year ends, it's here.
Okay. So Shane, is there any times where, like, maybe people watching have heard, okay, I think this is me, but I'm not quite sure. There's scenarios that maybe, yeah, you own something jointly, but there's probably an exclusion or it wouldn't apply.
Yeah, so you have to look at these rules in details, and one of the most common questions I ask is usually in the spousal context. Does it apply? For example, the family home. Maybe it's in one person's name, but you have the individual and their spouse living in the home. Well, that spouse is obviously beneficially interested in the property. Does that create a bare trust under these new arrangements? And you have to look at the underlying terms and things like that, but generally probably no, not in a family home context.
Okay.
And the reason being is, yes, your spouse might be beneficially interested in it, but it might not be because of a trust relationship. It's probably due to matrimonial law and things like that why they're interested in it. So there is some situations where you could probably, when you look at the definitions, think that you might fall into some of these rules, but you might actually not. And it's important to get that type of advice and to make sure that you're on side with these rules.
Yeah, so if someone's not sure, you're in a situation where it's like, kind of on the fence, I don't know, and I had a client email me just the other day and asked me, like, here's my situation, I don't know what to do. Who should clients be reaching out to and contacting to get information on this?
Yeah, so the best probably person to reach out to is your accountant, or if you don't have an accountant, to find an accountant to do it. Obviously, we're going to have to gather lots of facts in the situations and make a determination. Now, part of the problem is that there is still a lack of guidance out there on some of these situations.
Surprise, surprise.
Yes, there's been some situations where CRA has provided some clarity, which says they do not expect a return in certain situations.
Okay.
Not any of the situations we talked about here,
Yeah.
but other situations where they probably would fall into it. And the hope is that the government will provide more clarity on it. Whether it happens before the first deadline of these rules or not, we don't know. But again, reach out to your accountant. That way they could look at your situation and walk you through the rules of whether you have a filing obligation or not.
And if you don't have an accountant, find someone in your area that can walk you through this, probably like an hourly consulting fee. But get knowledge around, like, do I qualify or do I fall under this filing? Because, again, a lot of you are joint on, kids' accounts, parents' accounts, and you think you've done this for simplicity a lot of times, or
Yes.
now I can help mom pay the bills, but it's also now created a bit of a can of worms for you in that you now have a tax filing to prepare, and there's obviously cost to that too, which, depending on accountant and how much work there is, it could range, a couple $100 up to thousands of dollars potentially.
Yeah, like we're actually thinking that the cost is going to be slightly over $1,000 to prepare these returns in the first year, and the reason being is that obviously there's the preparation cost. Most of the time, these arrangements aren't documented, and so to actually file the return, we actually have to get some type of documentation of this arrangement.
Yeah.
Now, it's a fairly simplistic couple-page document, but it still has to be submitted to CRA to be able to file these returns. And then we have to get a bunch of information on all the parties. And so that just takes time.
Yeah.
And because of that time, there's a cost associated with it. Now, the filing obligation, if you do not file this trust return, comes with some consequences. There are penalties if you ignore the rules, and if you don't, and even if you didn't know about the rules. So there's a late filing penalty, and that could be up to $2,500 if you late file the return.
Oh, wow. Okay.
And there's even a gross negligence penalty. So if you knew about the fact you had a filing obligation and you still chose not to file, then the CRA could actually assess a penalty up to 5% of the assets under trust.
Oh, wow.
And so, you think about those assets, those bank accounts or something like that, and 5% could add up.
Yeah.
And so, it's important to figure out whether you have a filing obligation, talk to your accountant. and make a determination, because the risk can be significant.
And when is the filing deadline for this?
So the filing deadline is actually 90 days after the end of the calendar year. This year it happens to be March 30th because of the leap year.
Yep.
But because of Easter weekend, it actually gets kicked off a few more days because of that.
Yeah.
So a little bit confusing.
Which I'm sure
there.
people will take advantage of. Yeah.
That's right. But yeah, normally it's 90 days after the end of the calendar year for these things.
Okay. And just to wrap this up, to understand kind of how crazy this whole process is and the filing, and you might be sitting there saying like, why do I have to do this? It's just more cost. You were sharing your personal story with me before we started recording this, and I want you to share it because I think this kind of highlights kind of how crazy this whole process is.
Yeah, with my personal situation here is I have a unique situation where my vehicle is actually a part of a trust.
Okay.
So I am the legal title holder of my vehicle, but my vehicle is shown that my company owns it. So it's on the company's books. I depreciate it and show all the ownership on the company. I did this a number of years ago before these rules were even imagined, but all of a sudden now I have this bare trust filing obligation, and I have to file a return to report the fact that I have a different beneficial owner of my vehicle than me legally.
Crazy.
It is crazy. And, so there's a lot of situations where you've done a lot of transactions in the past where you think are fine and stuff like that, what can cause you to have a filing obligation. Yeah. So in my case, yes, I am filing a trust return.
And you may
for my
change
vehicle.
the structure going forward so that you don't have to file every single year, but...
Absolutely. And is there good business and other reasons to do some of these structuring? Absolutely. Yeah. But now it just comes with a potential obligation to file this return.
Yeah. Which I think for business owners watching this, you might fall into some of these weird scenarios. Again, talk to your accountant about that. For a lot of the personal situations, again, a lot of you are doing your own accounting work and tax filing and that kind of stuff. You don't have an accountant. But again, if you think you fall under one of these criteria, make sure you do reach out to an accountant. It's very important to make sure you get this, get the knowledge behind it and then get the filing done if it applies to your situation, which again and again, we see people in their 60s, 50s, 60s, 70s, get added to bank accounts, to real estate on their parents. Very common, and they're trying to simplify the estate planning and avoid probate.
Yes.
And we've said before on this channel, it typically doesn't work well, and now we're adding another layer in where you have a tax filing now, which costs money and time and effort and all that too. So again, a lot of times we try to simplify our world with some bad advice, and it keeps kind of hitting us in the knees, and this is another situation.
For sure. And there is a lot of exceptions to these rules and things like that. For example, the bank account one, there is some exceptions in the rules, but you have to meet the exceptions. One of the most common exceptions for bank accounts is if the balance in that account is less than $50,000 throughout the year. But it's a throughout the year, so any moment that it's above that $50,000 has a filing obligation. So your parents get a redemption of a GIC, goes into the bank account, goes out the next moment, you have a filing obligation. Those exceptions don't apply to real estate and stuff like that, but you could actually be in one of these situations where it's like, oh yeah, I'm on my parents' account. But maybe there's actually an exception that you don't need to file. Okay. So it's important to, if you're in that situation, to make sure you get the advice. And if you are in that situation, it might be something you have to monitor every single year or two to see, do I have actually a filing obligation this year or not under these new rules? And obviously these rules are going to change over time as well.
Absolutely. Yeah, well, and that's a good exclusion there. So if I'm joint on a parent's account and the account throughout the year never goes above $50,000, then I would not kind of fall under that rule for that account.
That's correct.
But again, a GIC pays in or anything pays into there at any point, bumps above 50,000, now you have a filing.
Yeah, and so that's why it's important to get the advice and honestly to make sure that you're up to date on those advice if you're talking a year or two down the line, and just to make sure that you still qualify for an exclusion, or maybe the rules have changed in these situations.
Yeah, perfect. So we'll put some links below to help support you in doing your own research around CRA links and whatnot. But again, reach out to your accountant, have that conversation with them to see if this qualifies or if you apply under these rules, because a lot of you do and you don't realize that you do. So Shane, thanks again for joining us here today. If you want to learn more about Clearline CPA, which Shane is a partner at, they work with business owners here in BC, Greater Vancouver area. We'll put their contact information below. So thank you for joining us, and we'll do this again soon.
Okay, thank you, Adam.